Have you been confused with the current Bay Area real estate market? I'm sure you're getting articles and news reports of constant pundits debating about a hard versus soft landing. Is a recession in Q1 or Q2 of 2024? Wasn't it supposed to be in 2023? Yet home prices have increased by 9% versus last August. Why exactly has this been going on when rates now are around 7%? My name is Spencer Su, and our real estate team in the Bay Area has been helping 1 to 2 families every single week get into contract over the last several years in a row. So we have a very forward-looking view and understanding why our clients and many others are making active moves every single week. Let's do a quick recap though since 2022 so you understand what's been going on. The record high of home prices isn't actually now. It was actually April and May of last year. Interest rates at that time had already been increasing, but they continued to accelerate and eventually settled at 7% at November of last year. Does that number sound familiar? Now this did have a lot of impact at that time. It affected buyers and their mortgage payments. Home prices dropped significantly because it was a very big run up. Because most importantly, valuations of a lot of people's stocks, especially in tech, took a very big hit. This also corresponded why home prices hit a low between December of last year to February of this year. However, things changed drastically starting in March. Now why? While the Fed continues to increase the Fed fund rate, this didn't actually impact mortgage rates, but there was a period that actually dropped to about the low sixes. The reason for this is because inflation was already cooling and there were signs that the worst of inflation is behind us. So what then happened between February of this year and today? You can see here that home prices increased by 21% and we have hit a current high of the year. Even though we're in the fall season, which historically spring was the hottest real estate times of the year. Now I'm going to explain all of this, why it's happening, and what we can predict moving forward. Now things aren't all rosy for the industry as a whole though. When you have sticky high rates, it means there is for sure less buyers, but also less sellers. The question though at the end of the day is, has the ratio changed? And what does the numbers look like each? Let's look at the data itself. The beginning of the year was absolutely terrible for the overall real estate market. Look at the number of transactions in 2023, compare that to 2021 and 2022. There were months where it dropped by 48%. Now look at the number of new listings. It was also terrible at the beginning of the year. There were some months where there was 40% less homes coming on the market. This also then discouraged buyers trying to find a place because they felt like there's nothing to buy. Now, the reasons for the seller side not wanting to sell is fairly simple. Remember this, when rates drop or if they drop down the road, you can always choose to refinance literally for free. And if you can do this multiple times when the spread is big enough, people will keep doing that. That's why most homeowners have an incredible rate of under 4%, which makes it harder for them to want to sell. That being said though, people will still need to make moves as long as the equity in the home is there, because they still need to use that equity into buying a new place for their own reasons. That leads us right now to the exact situation on the demand side. So you're probably wondering now, Spencer, where the heck is this demand coming from? How can all these people still have money in the Bay Area? I thought there was no money. I thought there's no jobs left. I thought mortgage rates are at 7, so nobody wants to buy. Now, partially it's true. The investor pool is significantly less for sure. However, there is always people that have money locally and internationally that want to settle down and lay roots here, especially if you want to be in the tech capital of the world. Also remember this when it comes to timing. If you are someone renting, unless you're 100% sure that the market is going to tank, it is a better idea to put that rent into your own home and build equity. There are ultimately 4 primary sets of homeowners today that I see all the time. You may relate to one or many of these things. 1, if you have kids. 2, you just got married. 3, unfortunately going through a divorce. 4, you're relocating because the return to office is real and the traffic is horrible now. We got plenty of clients in Brentwood, Tracy, Livermore that has an incredible deal from a few years ago. But that traffic now to get to your office is 1.5 to 2 hours in one way, and that is just crazy. Give you some perspective, I had a client that lived in El Dorado Hills in Sacramento, and we sold her a 5,000 square foot home and moved into a Sunnyvale townhome for the same price. And that was only 1,500 square feet. The commute is real and it's bad, and if you have to report back into the office, people will make the adjustments accordingly to just not bear that, because that would be a terrible lifestyle. Now the other situation is that people had waited over a year already to see what would happen. The rates are very similar to what they were last November, but still today. But prices didn't drastically tank. Accordingly, buyers always still could have bought but had to keep moving on with their lives. Your kids, your life, your commute situation. really wasn't getting any better and only worse. So why not make that move now if you have the ability to do so? And people are. Now, I did promise I'm going to give you my thoughts moving forward and why. I personally don't think rates are going to drop anytime soon, so I'm not pitching that at all. But I also don't think they would increase too aggressively anymore. That's because inflation is quite sticky, but it's not out of control because there's still tons of money still circulating out there. People still today have the ability to buy, and the stock market has nearly recovered to all-time highs. Never mind if you work at an AI-related company or you're at a company like Nvidia, you guys have catapulted into the $1 trillion club. So what does this all mean then for a home buyer or seller? So because of these things, I don't think rates are going to be a whole lot better, but I also don't think prices are going to skyrocket, but I also don't think it's going to really tank. It'd probably be somewhat of a mild, some months maybe a little bit better than others. Maybe a slight increase here and there, slight decrease here and there. So what does this then mean for home buyers and sellers? Buyers have been able to adapt and make the decision to choose now to settle down and enter in the market. They do have to be ready, but more listings have been coming up. Don't be surprised that interest rates still keep mildly increasing, but the big spikes seem to be behind us. As home prices have increased though, sellers are wanting and willing to sell as they have tremendous equity in their homes. Just because you have lower rates doesn't mean you can live in an inconvenient house long. It's always funny to me that people complain about having tremendous equity in their home and having to pay taxes. Would you rather your assets be underwater? Whole lot better than if you're a renter too through these years, as you have had to pay years of rent to a landlord and not build any equity. I expect similar to what we have seen recently over the last few months, that we're going to see a lot more buyers come back in, but we also see a lot more sellers put their homes on the market. So if you are a motivated buyer or if you're a motivated seller, you need a strategy to win in this market today because it is completely different than the market of before. And if you're in need of a strategy to win in this market today, myself, we would love to help. You can schedule a discovery call, which is a free Zoom call with myself down below, or send me a text to arrange a time. Looking forward to talking to you. Thanks for watching. We'll see you at the next one.